Waiting on Zoom. There we go. I told you Zoom was having trouble this morning. What's up, everybody? My name is Jay Helms. I'm the founder of this movement and podcast known as the W2 Capitalist. Today, I'm joined by multifamily syndicator Earnest Harbin. Did I get that right?
You
Earnest
did.
Harbin. Ernest, let me give you a little brief bio of Ernest, and then we're going to dive into some questions and just chat a little bit. But Ernest has spent his entire professional career focused on real estate, which has shaped the company's investment philosophy. Excuse me. We were just talking about how I don't have enough coffee yet, and attracted him to real estate investing as a viable investment partner that is trustworthy and dependable. Now, this is all coming from his website, apartmentbuys.com, which I'll link to in the show notes. But Ernest and I were just talking. Ernest, are you a native of Georgia, or you just spent most of your life in Atlanta?
I am a native, born and raised.
Born and raised. And we were just talking about how you spent your entire career focused on entire lives focused on investing in real estate, which is pretty cool. So you've actually never had a W-2 job, right?
The only W-2 job I've ever literally had was just out of high school. I sold Subway sandwiches for about 3 months.
Yeah.
And I sold cars for about 6 months. And then I realized that you couldn't be the man working for the man. So
Gotcha. So let's get the important stuff out of the way first. Georgia Bulldog or Georgia Tech?
You know, I don't even watch football.
Oh, really? Okay. All right.
I'm a motocross guy.
That was the thing I noticed about you. So you're an adrenaline. I saw you on your Facebook page. I was trying to stalk you a little bit on social media, and you've got some photos on there of you doing some pretty kick-ass stuff, in my opinion.
Yeah.
Right.
And those pictures are just within the last couple of years too. And I'm 48 years old.
Oh, wow. Okay.
Almost 49 now.
So are you just a natural adrenaline junkie, or do you just enjoy something about motocross?
Yeah, actually, I'm not really an adrenaline junkie. I actually just was really naturally gifted on a motorcycle and just went really fast.
I want to go fast, mama.
Yeah, I was like the Ricky Bobby,
man.
I just want to go fast.
How did you discover you had a natural talent for being on a motorcycle?
Well, when I was a little baby, my dad actually rode a little bit, some races, and I picked up on it. And all the years I was younger, and most kids actually wind up getting started at an early age.
Yeah.
I actually didn't even wind up getting started until I was 15 years old.
Oh, wow.
And,
okay.
And I basically went from first bike I ever had at 15 to turning pro in 3 years, and rode pro for 2 years.
Wow. Okay. That's incredible.
That's a whole nother story in and of itself. It's pretty cool, actually, but not real estate oriented at all, but it's still a pretty cool story.
It's not, but I'm really intrigued. So let's dive into that for a minute. So do you still race now professionally, or no?
No, I actually quit racing professionally in 1991.
Okay.
And then over the years, I just kept riding and racing, and actually transitioned into off-road for a while, and did was really fast at that. Got to expert level. I never got to pro level, but I did get to expert level, and was going to do the Baja 1000 in Mexico, and got hurt really bad right before that and never made it. So I just kept racing off-road and motocross all through the years. And the last year I raced was tail end of 2017. And my bike actually got stolen, and I just never went and bought another one. And I haven't ridden in about 2 years, two and a half years. But yeah, I guess it's kind of like the story of being around the right people. They always, that whole regurgitated saying, your network is your net worth, but your top 5 people. Well, I actually wind up getting, by sheer coincidence, got to be really good friends with via another friend, the factory guys, the guys who were getting, the number one guys like you see on TV, they were getting paid. And my dad, and at the time, having private motocross facilities was not very common. And my dad had a heavy equipment background. So he built me a racetrack, and we actually invited the teams to come ride on it, and they accepted. So I wind up, we literally had the factory teams coming to our house, riding on our track. And I just rode with them. And by me riding with them, I just got fast, really fast.
I bet.
And they would show me what I was doing wrong. And, when you chase guys that are faster, you just get faster.
So let's switch to, before we switch to real estate investing, but what's the difference between off-roading and motocross?
Motocross is basically, it's a small closed circuit where you can, where they jump the hills and you can watch them, so Supercross is stadium and motocross is outdoor. And then off-road is primarily essentially just riding in the woods or the desert.
Gotcha. Okay. Very cool. I don't think anybody was expecting that they were going to get a lesson in motocross, but
it's not normal. It's not normal for sure.
It's not. That's why I'm so intrigued by it. And having this podcast, I get introduced to so many different walks of life, and I'm always intrigued of, because I grew up. My dad raced motorcycles when he was younger, before us, and before my mom, I think, convinced him to not do it anymore. Right.
Awesome.
And, so he introduced us to the idea of riding, and bought us a little Honda XL75, which I think he still has, but we didn't take it much from there, right? So, and it was a 1970s model motorcycle, but it was, I enjoyed it, but I wouldn't get on one now because I'm a little too, same reason why I don't drive a fast car. There's just
I've owned 4 Lamborghinis, but I'm not a speed junkie, which is ironic.
That is ironic. Yeah, that is ironic. But anyway, so back to, let's switch to real estate investing, right? Main thing we want to sit here and talk about. So, you bring up the comment of being around the right folks, regardless of your profession, right? You get around those guys who are the experts at motocross. You get around those guys who are the experts at real estate investing, and it's just going to raise your level of competence, right? So how do you go about, when you first started investing in real estate until now, right? How do you go about continuing to improve your circle of influence so that you don't get stagnant, or, what are some of the things that you're doing now to kind of help continuously improve that cycle?
Well, let me tell you, when I first got started, obviously this was quite a few years ago. We didn't have social media, cell phones were, it was back so far as, flip phones. You didn't have the digital phones, in any of that stuff. So, we texted, you had to click the 7, 3 times to get the, the Y or whatever it was you had to get, right? So, so it wasn't like it is now. So, and unfortunately, I never was really good at networking. And I was always a bit of a lone wolf, which is kind of how I guess, I was talking to somebody the other day on a little bit of a sort of a limiting beliefs concept, in which I didn't have. I was a very motivated individual. And when I got started, it was kind of like, I was just driving for dollars, but we didn't call it driving for dollars back then. We just called it looking for houses that were boarded up.
Yeah. Yeah.
So we're just, so I got in, I just started networking with the brokers, and, and of course, since we didn't have internet, deals were more, I say they were more prevalent because they weren't so easy to get to. You couldn't go on a program and find, have 5,000 foreclosures sent to your inbox, where you got 90,000 investors looking for them.
Right.
So, in some ways, I think it was actually easier, but as I've transitioned, I moved forward, and people are always asking me, well, God, how did you buy, 400 plus apartment complexes by yourself? I said, well, hell, I didn't know I wasn't supposed to do it that way.
Yeah. So it's good and bad, right?
Yeah. And, so after I did it, and, thinking back on it now, it was work. It was, difficult times. And there were a lot of times where I really did wish that I had other people helping me, but I just didn't know.
Yeah.
And not that syndication wasn't, this is just, I built my first set, probably early 2000s. And then, I bought my first set that was pre-built in 2010. And And, you know, I just didn't think nothing about it. I just did it, you know?
Yeah.
And, so, um, so I just worked my way through that. And then as I, you know, circle back around, I've decided to take a bit of a different approach, you know, seeing how things have changed. You know, the syndication model is much more prevalent now with, you know, the new exemption rulings and things of that sort. So it's changed things. It's changed things a lot. So I just decided that, you know what, I'm older and more experienced, and I just don't want to have to go through that much work again.
Yeah.
You know,
No.
I would much rather share the responsibility and work with other people, because frankly, working by yourself all the time is very, very difficult. And,
Yeah, I
you know,
agree. I agree.
and being able, and it's not, and I tell people all the time, I say, you know, it's not that, it's like building a house. It's not that I can't go put the tile in. I mean, I had a paint contracting company for almost 9 years. I can go paint a house. I can put, you know, I've put roofs on, I can put tile in, but should I? No, it
Right.
doesn't make any sense. You know, so it's kind of like when people are talking about doing deals, and the truth is there's some aspects that I'm not as good at. You know, I'm not a phenomenal number cruncher.
Mm.
So for me to sit in front of a computer and crunch numbers all day just ain't my thing. I tend to be a little bit more of a, you know, a 3,000 foot view guy.
Yeah.
You know, an idea guy. So that's kind of where I'm at on that type
Yeah.
of thing.
And, you know, you make a good point there about making the best use of your time. I've got some guys in my mastermind group that they were giving me heck because the house we live in, my wife and I live on now, it's somewhat of a fixer upper, right? It was built in 1979, 1980. Hasn't really been touched since. And a lot of the work I'm doing myself. And the guys in my mastermind were giving me heck about, is that really the best use of your time? You know, because I'm always giving it to them, saying, "Hey, look, is that
Right.
the best use of your time? You know, is that going to advance your?" And and I'm not the best tradesman, but there's something about just mind-numbing work. You know, putting down baseboards, painting a wall that I enjoy every now and then. I don't enjoy it all the time, but there's every now and then I've got to just do some manual labor just to reset. You know, let's talk about your very first deal. You and I were chatting a little bit before we hit the record button about you house hacked your very first apartment deal, right? So let's dive into that a little bit because I don't know that I've heard that before.
Well, actually, so what I did, you know, as you know, through the years when I got started, you know, buying properties, flipping houses, um, I graduated into building houses, and I built houses for a couple of years, you know, for about 4 or 5 years. And then, and I always pretty much knew I was going to get into multifamily. I mean, it never was oh, I woke up one day and said, let me just try my hand at, you know, apartments. I mean, I always knew I was going to. Now, I really got lucky with my first deal in a sense that, at the time I was looking for places to build some houses, and I just happened up on this quasi subdivision that some elderly lady had owned,
Hmm.
and it was like it was built like a T, and it was
Okay.
laid out, and it was laid out, you know, a T. It was subdivided out into these lots, and when I got to looking at it, and to this day I don't know how she wound up doing it, but it was zoned R3, which is, you know, or R13, I think. I can't remember the zoning now, but it was multifamily zoning. So I was like, well, hey, you know what? So I just struck a deal with her. I said, well, I'll tell you what, let me just buy a couple of lots at a time. I'll just build the I'll just build the apartments across them. And then I'll buy a few more lots until I take down the whole thing. And it wind up being, that way I didn't have to buy the whole thing. I didn't have to develop the roads. I didn't have to put in the infrastructure. It was already there. So, you know, so I would have to say that's kind of a, you know, certainly something you don't come across very often. So I just built the units, and then after I got them about halfway built, my wife and my daughter at the time, we actually just wound up moving into one of the units, one of the 3-bedroom, 2 baths. And at the time, nobody even knew I was the owner. They just thought I was just working on the property, building the, you know, nobody ever did know I owned them the whole time I lived there that I'm aware of.
Well, you say you're lucky, but you had to be looking for this. I mean, you had to be, you know, I think luck's something you make on your own, right? And I think you had to put in some hard work again, this was back, like you said, before really the internet age, right? You had to drive around,
Oh yeah,
not driving for dollars. You were driving for houses boarded up. You saw this, you got really creative. You found the owner, which I don't even want to know what that process looked like before. I doubt you could text I mean, I imagine you had to go up to the courthouse and look at all these different records, right? Or start knocking on doors and asking people, hey, who owns that piece of land, kind of thing.
Well, that's what's funny is she had actually built a duplex on the very first lot. The lady did. So that originally I got the idea of maybe I just built some duplexes like she did. And then it turns out that I wound up building 8 plexes and, building the whole thing out with 8 plexes. And that's how, wind up with a total of 88 units. Well, she lived right behind the property. Her house backed up to the property. So I don't remember exactly how I found out that she owned them, but I got, I met her and talked to her about it, because I wanted to maybe do the duplex thing. And it just turned out to be better than I had thought it was going to be, really.
Yeah. Yeah. The only thing I would say is just start knocking on doors, and if you're running that situation now, there was, this has nothing to do with real estate investing, but there was there's a huge sunflower field over in Alabama that we would drive by. My wife's like, oh, I love that. I want to take some pictures in that field or whatever. So I just start going knocking on doors. Hey, who owns that piece of land? And after 2 knocks, I get the owner. They tell us, hey, yeah, you guys can go out there, whatever. And I imagine it was the same thing, right? Is you're just knocking on doors and got extremely creative with that lady to work that out. So that's incredible. Hey, real quick, do you invest in Atlanta only, or is that just where you're based?
No, that's just where I'm based. And
okay.
And all the investing that I've pretty much done up until now has been in Georgia, but I am now looking to try to, I'm looking in Alabama, Tennessee, and South Carolina, and, some parts of North Carolina, and, maybe a few areas in Florida, like Jacksonville or something, or anywhere that might work out like that. So
somewhere in the Southeast.
I was going to say pretty much the Southeast.
Yeah.
Because that's what I know. I know that the best. People talk about all the time, and that's one of the things that I talk about with other people is, it's sort of a little bit of a stay in your lane concept. It's like, I talk to people all the time that say, oh, I'll just buy a deal anywhere that's a good deal. Well, you know what?
Yeah.
Hell, there's areas where I live that I don't even know, close by me, and it's very close. The construction's similar. A lot of the laws are similar, so, the Southeast tends to be the same. But just because there's deals to be made in Ohio and Oklahoma City and Phoenix and Dallas, well, I don't know anything about those markets.
Yeah.
I mean, if I'm a big player, maybe that's different, but for people to just be carting all over the place, you buy 60 units somewhere. Well, hell, you got to get on a plane to go look at it. I mean, they don't produce that kind of money to have that much headache to go all over the place. That's just my opinion. Lots of people do it, but it just doesn't make practical sense to me.
Yeah, I run into a lot of people do that too, and I'm glad they do it and not me. I'm glad it's not a requirement of an investor. You know what I'm saying?
Yeah.
I was just curious because Atlanta is such a huge market. We have to drive through there to go see our in-laws, and I don't know how you guys do it. I just don't like the traffic. The Peach Pass is one of the best things I've ever purchased.
Well, my houseboat is up 85 on Lake Lanier, and I have a Peach Pass to get up there. So that's you're right. I mean, on 85, that's the golden ticket right there.
It is.
But
it's the best.
You're right. I mean, certain times of the day, going through Atlanta can be pretty bad. I mean, depending on what time of the day I go, if I need to go like to North Atlanta, I can get there in an hour, or I can get there in an hour and 45 minutes. It depends on what time I leave.
Yeah. Yeah.
It's that bad.
So you first started out doing all this yourself and building units, and now you're doing syndications. But would you rather build something new now, or would you rather buy existing? What's your preference today, or does it really matter?
Well, that's funny. My girlfriend actually has been, at me about really building something. The only hesitation is, building something, the few drawbacks to the pros and cons to building is new construction sometimes can be a little more difficult to raise capital for. And also new construction takes a long time.
Yeah.
But on the flip side of that, when you get done, you have a new property. And now, so the key to buying something that's pre-existing is that you can buy it, the largest selling factor or key factor that a broker uses is that you can buy it for significantly under replacement cost.
Yeah.
So if you can do that, then you can buy a much larger property for a much lower price, ideally. And then, that's where you make your money. So if you're gonna build something, but prices are so high now, I mean, C-class properties are going for $75,000 a door.
It's crazy.
I mean, shit, you can build it you could build a relatively similar property, not a C-class or a garden style type property, market rate to garden type, as opposed to building some highfalutin, A-class, really high end stuff. Yeah, I mean, that's different.
I appreciate you making that clarification, because when you said that, that's where my mind went, because that's what we typically look at. I stay away from the Class A's somewhat for the most part, because we're interested in the cash flow, right, and not so much the appreciation. So that I'm glad you make that clarification, because a lot of people are probably not thinking that. They're like, oh, I can get best neighborhood for this or whatnot. That's good.
Well, it's a very distinct, or a distinction that needs to be made, and people need to try to understand that at least a little bit. When you're talking about classes, you also have different types of construction. When you have Class A high rise, I mean, you're getting into a whole nother different type of construction, inner city type stuff. Or you build garden style apartments. Garden style apartments are built more like a house.
Yeah.
Whereas other types of properties are they're metal stud, concrete, and higher off the ground, and they're just built totally different. So the cost of construction is much different. But when you got something you're paying, something that's built in the 70s, you're paying $75,000 a door for. I mean, God, that almost it just don't make any sense anymore.
Yeah. And what is the cap rates you're running into right now on something
right now? At least, right here, at least in Georgia, Alabama, and Tennessee, well, I guess even Carolinas, really. I mean, it's very common at this point to be paying a 6 or 6.5 cap for a C-class property.
Yeah.
And to me, that's
really expensive. To me, it is.
But I will tell you, one of the biggest problems that we run into, and I was even wanted to write a blog or some sort of an article or something about it, was basically, the pixie dust in the OMs and the brokers OMs is basically, if you could buy a property at a 6.5 cap on its current operations that needed full interior renovations, use that as an example, and then you could raise the rents $150 a month over the course of the next, year to 18 months or 24 months or whatever, then you can get get it up to, let's just theoretically say, get it up to a 10 or 11 cap, or get a 4 or 5 basis point spread. By doing that, then that makes sense. Then you're stabilizing it, you're getting it fully fixed up, and you're getting it to that point where somebody should pay a 6.5 cap. But you can't pay a 6.5 cap on the numbers, what it's going to be after the fact. And that's what I'm finding consistently that people are doing. And that just tells me that there's still more money out there than there is sense.
Yeah.
It's not, I mean, really.
I'm writing that down. No, you're right.
We could talk about all these nuances that people talk about. The sky's falling. We're going to get a recession. When's it coming? Nobody has a crystal ball. But the truth of the matter is, when people are just consistently overpaying, and they're overpaying because they got money, syndicators want to raise money. So while they can get it, they want to keep raising it. They want to keep buying. Yeah. At some point, like the old adage say, the piper has got to be paid.
Mm-hmm. Yeah, I agree with you. And it has been frustrating for me to kind of sit back and say, okay, I'm going to pump my brakes a little bit. I'm not going to try to do anything. And then I kind of took an approach where like you did. I didn't apartment hack my first deal, but I did syndicate it with a couple of guys. And then now I'm to the point where I've invested in 2 different other apartment complexes where I'm just a limited partner, right?
Mm-hmm.
So I'm enjoying this side because there's not, I mean, I crack on the phrase passive investing all the time because I don't as passive, or it's not truly passive, but it's more passive than syndicating a deal or trying to run a flip or something like that. But I got to tell you, I'm enjoying the heck out of the limited partner side. And I get to rely on those guys who, the folks that I'm dealing with, I want to clarify there, they've got a really good track record. I spent a year watching them and
well, I know those guys well. I know most of them.
And understanding who they are as a person, not just the deals they were putting together. So I've started that way, but we're talking about just the overall market, right? Where do you think it's headed? If you had it, what's your crystal ball telling you?
Well, this is what I tell everybody when everybody starts talking about the market, the recession, what's going to happen. I'm not an economist. I'm not a data scientist. My whole career, everything that I do in life, I just work off of freaking good old fashioned common sense and what I see going on around me. And, I sort of relate what's going on. When we got hit in 2008, the government and lenders had been, they went through the 80s, the high flying 80s, the 90s were great. And then everything kind of, leveled out. I think, when was it? Was it late 90s when we had that one crash, like 97 or 98 or so, or 2000?
I was still in high school,
exactly.
So it wouldn't, I don't know.
Well, so we kind of had that crash, a bit of a recession. And then we had, and then everything went back up again. And then in 2008, at that time we'd have, the whole 100% financing and they were putting people houses left and right. I mean, they couldn't get people in houses fast enough.
Yeah.
And it was inevitable that, a bust was coming. Well, when it hit, and a lot of people don't understand too, this gets really off track of the topic of this, but it really had more to do with Wall Street underwriting, credit paper, and things of that sort. So when it really hit, I mean, it was like flushing a toilet.
Yeah.
I mean, it just, everybody took a bath. And when it did, I mean, it was like, everything imploded. So when the economy took a 20 or 30% haircut, so everything had to get washed out, so to speak. So now, since 2008, now a decade has passed, a little over a decade's passed, and we've had the fastest and highest growth rate that we've ever had in history, 100 years, or I don't know the exact, statistics on that. We've had the highest growth rate. That's why people in the last 5 to 6 or 7 years have knocked every deal they've done out of the park, because it's like all you had to do was buy something.
Yeah. Yeah.
And so essentially, they just, they were buying things. So, but the lenders have tightened things up. They've done things where it's, the people have more, what do you call it? Credit in the deals.
Right.
They have more of their money in the deal. So the parameters are much different now. So long story short, we'll get a sort of a pullback like you do in the stock market. When something goes up, you get a pullback, and, you get stabilization, and then, and it kind of bobbles along. I think we're kind of at that bobbling along stage where everybody's still buying. They're not really going to pay more because the prices have kind of stabilized out a little bit. I mean, it's, in the last several months, C-class and B-class properties are all kind of getting bought in those same price ranges.
Yeah.
And that's kind of where they're at. So at this point, it's just going to it's going to be whenever people stop seeing those 20+% IRR returns. I talked to an investor the other day, and she actually said that, she paid her initial investors back, in the last couple of years, paid them back so much. The returns were so high that she had actually, inadvertently conditioned her investors to receive those, exorbitant returns that they actually, some of them didn't even reinvest back with her in other deals, because she said, hey, I can't promise that stuff. I don't know if I'm going to triple your money, because those values are not there, not like there anymore. And there's a lot of nuances of that. There's only so many properties that were built in the 70s and 80s. There's only so many properties built in the 80s and 90s and so forth. So you take all those individual properties, 50, 60, 70, 80% of those properties have been bought up, renovated, resold, or are now at the point of, their 5 to 6 year holds through syndicators. And now they're trying to sell those properties. So the amount of properties that are out there, to buy and flip and get that exorbitant forced return, there's just not as many of them available.
Yeah.
So, so there's a lot of factors at play there. So I guess to answer your question, well, I don't think we're going to see, everybody says, I'm going to wait to invest until, we get another recession. But I always tell everybody, hey, you know what? The best time to invest is any time.
Yeah.
When you buy something, if it makes sense, it makes sense, and whatever makes sense to you, but it has to make sense from a cash flow and income perspective. But
yeah, I'm with you. And kudos to your friend, for not putting herself or her investors in a peculiar situation, right? If they're used to getting these checks and she's like, wait a minute, we really hit the ball out of the park on this one. It's not going to be that great going forward, right? She could have really did herself a disfavor by over promising on that. So that's incredible.
absolutely.
There's a lot of people out there that just take the money and run, so to speak. But so one of the things, so now you're moved on to syndications. I want to make sure we cover this part because we're running up on time. But right now you're looking for people to partner with for syndications. You're looking for opportunities and those folks. What does it look like to do a deal with Earnest Harbin and apartmentbuys.com? What does that look like?
What I try to do is I don't find as many deals. I see a lot of syndicators that have kind of adopted a model where, and I always preface this, there's nothing wrong with it. It's not the way I'm choosing to go at the moment, but there's so much money out there, and there's fewer deals. So to get a deal done, you're going to have to buy a deal where there's just not as much upside. So you can buy a deal, raise capital, and just get a deal done so that you're doing something. So you can buy a deal, you can create a yield play for your investors, and using the property as the vehicle. And then the more deals you raise capital for, then you can operate as an assets under management type concept. Instead of, so what I always refer to that is they're making money off the deal as opposed to on the deal, which is why a lot of syndicators are going to these, 80-20. I mean, I saw one the other day, it was an 85-15 split. And I'm thinking, I'm an operator. I'm a look for the deal, acquire the deal, renovate the deal. And, I'm thinking to myself, well, I'm not 15%. Even if I was the only GP, I'm not taking 15%.
Yeah. That's low, right?
Yeah. I mean, there's nothing there. So when I see a deal like that, and I actually told some LPs the other day on another call, I said, you as an LP, I said, it's nothing wrong with it. It's just be aware, because they always say, well, I just want to invest in deals that are conservative. Well, if you're investing in a deal that a GP is willing to take that low of a split, to me, that's a concern.
No,
why is it so conservative? So I always,
it's a great point. So, one of the things you got to want to do is, if you have a general partner, you want him or her to stay motivated in the deal, right? And if that property's not producing, and even if it is producing and they're only getting 15% of the cut, how motivated are they going to keep going after, I don't know. That's actually a very excellent point. I've never thought about due diligence in a deal where you look at the split, right? Because I've seen them all over the board, 60 down to what you just said, 85-15. I have not run into one 90-10 yet. I've analyzed some deals, where it only made sense for the investors if it was a 90-10. And I was like, okay, it's not a deal for me.
Well, yeah, it does. It's not even a good deal for the, and I see a lot of packages where, they always say this is a conservative underwritten deal. But, I've looked at webinars where they quite literally are almost looking at ancillary income as their basis to increase revenue. You can't depend on other ancillary income. You can't depend on late fees, pet fees, laundry fees.
Oh, wow.
That's to me, I mean, you can put a little bit in there because there's some of that stuff that you can kind of depend on. If you got 3 years records, say, and you had $5,000 a year in ancillary income, you say, okay, you can plug that in. But don't count that as, where you're going to raise revenue. Don't say I'm going to do better or, and I see guys a lot of time, they say, well, we're just going to manage it better, or we're going to manage it because we have other properties. There's some basis to that, but, I just think every property should stand on its own.
Yeah.
And, and again, I look at the deal for the deal, because I'm looking at the deals as if, well, and traditionally all the deals that I did up until now, it was just my money.
Right.
So so it wasn't like I'm going to put this money here and I'm going to collect some fees, because guess what? There wasn't no fees to collect. It was either the deal made sense or it didn't.
Yeah. When I had Joe Fairless on, pretty sure you know who that guy is, but he and I were talking about similar question, right? And he said, look, you invest on the merits of the deal. If the merits of the deal pass, then you should pursue it, right? So very similar to what you're saying there.
That's what I say. I mean,
yeah.
it doesn't make sense to do the deal when it just doesn't make sense. I mean, and we could talk about this all day long,
Sure. Yeah.
But that's really how I feel about it. And people always say, you owe to your if you're going to take somebody's money, then you owe it to them to be good stewards of their money. Preservation of their capital is number one, profit second. And, and your reputation, if you care about your reputation, then, all you need is one bad deal to go south because you're an idiot, and you're done. Well, I mean, some people can recover, but basically
it's hard to, some of the things that I've seen it's hard to recover, right? And the reputation in this industry, I think is huge. So
it's a small world. I can tell you that. We just got back from Baltimore at Rod Cleef's event, which was a phenomenal event. And I have to tell you, you can't imagine how small the world is. I mean, I've got guys in California that I'm friends with, and they're sending me deals going, hey, I've got this broker sent me a deal in Alabama or Georgia, wherever it was. I said, yeah. I said, they sent it to me too. And, and you get to thinking, it's like, and when you get a deal package from a broker, well, you ain't the only one they sent it to.
Regardless of what they tell you.
Yeah. You're not their best friend.
So somebody who wants to invest with you or partner with you, do they have to be a millionaire? They have to, I mean, what's the, and let me preface that by saying, we're not your legal counsel. We're not, CPAs or attorneys or anything like that. But if somebody wants to invest in one of your syndications, what does that look like? What kind of requirements would I have to check off to partner with you on?
Everything that I'm working on right now is primarily going to be done under 506C. So the 506C ruling is essentially the ruling to where you can basically advertise anywhere you want. You can openly solicit money. I can take out a billboard on I-75 if I want to. But the caveat to that is they do absolutely have to be an accredited investor, which, if anybody
not sophisticated, but accredited, right? And you have to prove that accreditation. It's not just based off of your
word.
Your word. Thank you.
Yeah. I mean, ideally, I think initially they were going about it from the perspective of, being able to sort of self-certify, but now because, as things have progressed and SEC's tightened up a little bit, most syndicators or most even attorneys are recommending that, that you basically third party certify at this point. So, to CYA. So it's, so yeah, I mean, so at this point that's what we're working under right now is 506C.
Okay.
So, so they would have to meet accredited status.
Very cool. Very cool. So, as we wrap up, Ernest, I've enjoyed our time. Hopefully this is not the only time we do this, but I want to make sure we know how to get in touch with you. I've got links to apartmentbuys.com. You have a boatcast coming out soon.
Yeah.
We were joking around about that. You got a podcast recording studio on your boat, which I'm a little bit jealous about.
Well, the name of it, if I can shamelessly plug, the name of it will be Multifamily Insights Exposed and Uncensored.
Okay. No,
so it's kind of like it's like me talking about the ins and outs and nitty gritty, of what it takes to be in the apartment apartment business. And my famous saying is, it's not all cupcakes and rainbows.
That's right. And it's not, right?
No.
That's one thing that I try to make sure everybody knows is that we have good things and bad things. I had somebody call me out because I posted something. We actually had our very first loss when we sold a property. Basically the property, it was a buy and hold, but the property I held for 3 years. And when I sold it, do all the math, right, ended up costing me like 12 grand to hold on to this property.
Oh, but you came out good.
Oh yeah. But what he didn't see is that, we just sold another one a couple months before where it was a 428% return. And if I'm ever going to take a hit, this tax year is the year that I want to take a hit. Right. And it was in an area that I don't want to be in anymore. It was a property that I didn't pay attention because I didn't give the respect that it needed. And so I just kind of let it go. So, anyway, I don't know.
Well, you know what? Let me just throw something in there just real quick. I know we got to go. And then,
people, the sun's up. So the sun's up now. So now I know it's time to go to work.
I can see. People always talk about, what's your worst deal? What's your best deal? The funny truth is I've never really had a bad deal. I mean, almost all the deals I've ever done, I've knocked them out of the park. Now, some single family houses, I held some and didn't make much money. I think I actually had one property that I held for about 3 or 4 years. I think, about 3 or 4 years that actually I wind up writing a check when I went to closing. But what I want to emphasize about that is, nobody's perfect. Even stock traders make bad trades. Real estate guys make bad, sometimes they don't call it right. Sometimes they miscalculate construction costs, whatever, just because you did a bad deal, just because you did something wrong, doesn't mean that you don't know what you're doing. If you do 10 deals and 8 of them make a lot of money and 2 of them didn't, so just simple accounting, you did take the loss from that, deduct it against your profits on the other 8. We still made a lot of money. So are you still a winner or are you a loser because you didn't do good on 2 deals?
Yeah, I'm a lot better off personally, and one of the things, and this is where I struggle with, you always try to take the lessons learned, right? So
that's what I was going to tell you. You only learn the lessons in the bad times, not in the good times.
Yeah. Which is, I don't know. I want to change that about myself if I can, but it's always easier to reflect on what went wrong than to reflect on, what went right. Let me repeat, what went right. But,
you're right. You're absolutely right.
So, but I look at that deal where we lost money and I'm like, all right, what did I learn out of that? Okay. I learned there's an asset class I don't want to be in. There's a neighborhood that I don't want to be in. We had to replace some septic tanks and do a lot of stuff that was not planned for. Right. Mm-hmm. But was it worth that $12,000 fee? I don't know. That's where I struggle.
But you're not looking at it. Don't look at, just erase that whole thought. Look at it. This is how I always look at anything that I had to spend money on that didn't pay off. Say you got into a deal, you had to put up $50,000 earnest money. Hey, you don't want to lose earnest money because, it sucks. But what you have to look at it, or you really have to relegate it to, is cost of doing business.
Yeah.
You have cost of doing business. If you said, hey, I had to spend $50,000 to find out if that was a good deal, it wasn't. I didn't lose my earnest money. I just spent $50,000 to not get into a really crappy deal I was going to lose a lot more in.
Very true. Very true. Well, Earnest, we'll leave it with that, man. Best way to get in touch with you.
The best way to reach me is either through my website, apartmentbuys.com, or just Earnest at apartmentbuys.com.
Very cool. Very cool. Thanks for your time this morning.
Absolutely.
I will definitely link up with you again pretty soon. Well, I'd like to do this again soon when you got a new, I want to pick your brain on new construction. I don't know why. It's one of those things. It's one of those itches I think I'm going to have to scratch eventually, no time soon. But there's, one of the investors
do have this little townhome development we've been eyeing, maybe doing something right up in north part of Atlanta. You know, if you really want to scratch it.
I don't know if it's that big of an itch, but there's just something there that, you know, I went through this process where I thought I wanted to own a car wash, and I even, you know, got real close on putting one under contract, and everybody I talked to is like, don't do it. Don't do it. Don't do it.
Hey, let me tell you something, man. Car washes. I actually looked into that a while back. Even went to Car Wash U and all that stuff down in Florida. You know, it's like any other business. You know, if you can get it right and you get your operations down, it's a cash cow. It's not, you know, it's a business. It's not a real estate venture. It's a business.
It is a business.
You have to look at it from a cash flow perspective. But yeah, it's a good, that and self-storage. But I think those two are not bad.
Yeah. Yep. Yeah, I've looked at them. I've got my own one of those too, but they're wanting too much money for it right now. So we'll keep working on. Yeah, in this market, right? Earnest, thanks again, buddy. I will talk to you soon.
Absolutely, I appreciate it.
See you, buddy.
Thanks.